Good morning. We will pay attention to goods purchased and then sold on credit. The entity is a registered VAT vendor and 14% is included in the appropriate amounts. Purchased goods on credit for 9120, VAT included. That means that the amount includes the VAT and is worth 114%. So the amount that we owe the creditors is the total amount of 9120. If we want to calculate what is the cost price of the inventory excluding the VAT, we want to calculate 100 divided by the one that we know, 114 times 9120, and that will give us 8,000 rand. If we want to calculate the VAT, the one that we want is 14. The one that we know is 114 times 9120, and that will give us 1120. These goods were sold to Piet Kloete at a profit of 25% on cost price. That means we have the cost price now because the cost price that we paid equals the cost price that we sell it at. If I want to calculate what is the sales price, I will first calculate the sales price on the cost price, and that is the figure excluding VAT. The profit was made on cost price, so cost price equals 100%, and the sales price equals 125%. The cost price was given to us as 8,000. So if I want to calculate the sales price, the one that I want, 125, divided by the cost price percentage that we know, 100, times 8,000, and that will give me the 10,000 rand. If I want to calculate the VAT, the one that I want, 14, divide by the one that we know, 100, times 1,400, and that will give me 10,000 rand. If we want to calculate the figure of the total amount that the debtors owe, the percentage that we want, 114, divided by the percentage that's known, 100, times 10,000, and that will give me 11,400. When we purchase the goods, we owe the total amount to the creditors. Creditors is a liability that increases on the credit side, so we will increase it with the 8,000 and with the VAT. The inventory account will be debited with 8,000. That is a 100% account to indicate what is the actual cost price of the inventory for the business. Because we paid 1,120 to the creditors, we can claim this back, so we will debit that input, that's an asset. Assets increase on the debit side with 1120. When we sell the goods, we take this inventory out of our inventory, so my assets will decrease on the credit side with the 8,000. Cost of sales, that's expense, will be debited with the 8,000. We calculate the total amount that's owed by the debtors, and we will debit the debtors with both the amounts because they owe the sales price and the VAT. And we will credit the sales account with 10,000 and credit VAT output with 1,400 to indicate that is the liability, because 1,400 is the money that must be paid to SARS. What did we learn? Goods purchase includes VAT that can be claimed from SARS. So when we buy goods or we pay expenses, the VAT can be claimed from SARS. An asset for VAT input is created to record the VAT that can be claimed. When goods are sold, VAT is collected on behalf of SARS. Therefore, you have to create a liability for VAT output to show the amount that's owed to SARS. The only 114% accounts that you will have in your general ledger is bank, debtors control, creditors control. Then all the VAT accounts will be 14%, and all your other assets, liabilities, income and expense accounts will only be 100% accounts. It will always exclude VAT. So you can't show any income or expense including VAT. Income and expenses are transferred to your profit and loss to determine the profit or the loss between the money that you made and the money that you paid out for expenses. No VAT is allowed to be shown in the income statement. In the balance sheet, all assets, liabilities, and equity accounts will be shown excluding the VAT, except the three accounts that can include VAT, and that is bank, debtors, and creditors.